Good evening, everyone. I'm just going to give it a few minutes for people to join in case they're running late. If any of you here yet were expecting to see me last Thursday, I do apologise. I had a family matter I needed to rush off for last minute, so I do apologise about rearranging, but thank you for being here tonight. Normally, if any of you have joined the FTA webinars before, normally have Chris and Andy, the directors of Frank Taylor and Associates, with me doing a bit of ad-libbing for a couple of minutes before. And unfortunately, they're stuck on a train. So I can't really have a conversation with myself, although I'm trying to make a job of it for the moment. It's wise to give a couple of minutes for people to come in, and then I can get started, so I won't keep you for long. What I will do is I will shortly share my screen, go through an agenda for the webinar. Hopefully it's very useful, and you can all take something that's very useful for your planning or your concerns or the questions that you have. Of course, I'm more than happy to help on an individual basis afterwards. Just wait a few more seconds for more people to pop in, and then I'll get started with the webinar. A few more coming in now. So what I'll do is I won't make everybody who was here promptly hang on for too long. We'll get started. I'm just going to share my screen with my presentation and get started. So hopefully you can all see that. What I'll be doing is running through my webinar. It's going to take around an hour in total, the webinar itself, and I'll leave 5-10 minutes at the end for questions. So if you have any questions, there should be a box you can type them into, and I'll try and go through as many as I can at the end. If I don't get to yours, then I can contact you individually afterwards with an answer or a conversation. So this webinar is to cover specifically post-budget financial and tax planning. There'll be a range of topics that we're covering today because the budget has affected a few different areas. And really, I want it to be a general sort of overview of the budget itself, the impact that it may have on specific situations, the ideas that it's brought up in terms of future planning, and the questions as well, which we don't have all the answers for yet because the budget's left a few things to be confirmed. And really how you tie this into your overall financial planning and what you should do to account for the assets that you have, the income that you have, and plan for retirement if you're already in retirement, what to do in terms of managing your capital best to give you what you need. And of course, things looking forward like estate planning and what to do in future with inheritance tax, that sort of thing. If you haven't dealt with us before, I know many of you here tonight probably would have spoken to myself or one of my colleagues, but our firm is a sister firm of the Frank Taylor and Associates company. I'm the managing director of this firm and the financial advisor here. We are specialists in the medical field and the dental field especially, but all medical professionals really, as you can imagine, being linked with Frank Taylor and Associates in that remit. We give independent and whole of market advice to clients. So we're not tied to a menu. We're not tied to an agency where we have to pick certain products, pick certain funds, which may not give you the best advice. We are truly independent and whole of market, and that's very important. So we've listed some services that we offer there, and of course, we're going to talk about pension and retirement planning. I'm not going to go into detail on NHS pensions this evening. If any of you here have NHS pensions and you have questions, I've done many, many webinars in the past, and I can, of course, speak to you individually about your situation. So we are specialists in that area, and I know there's lots going on in NHS pensions, so it might be something of interest to come to us to have advice on. Tax planning really is a sort of key part of what I'm talking about tonight, because a lot of the budget updates are of course related to tax. We do give insurance advice here. Anybody who is a business owner especially, or employed and still working and not retired yet, You'll have insurances. You might want to review them. You might want to set up new insurances, look at things like private medical. We can do all that for you. We have an associated will writer in the firm, Susan Delahunty, and she specializes again in business professionals, but dentists and medical professionals specifically. So like myself, having dealt with so many people perhaps in similar situations to yourselves, it really does give us a crucial insight into the types of planning that you want to do, and we can sort of cut to the chase with your planning. It's if you don't have an up-to-date will or a trust or a lasting power of attorney for your estate on death, that's very important to look into as well. In terms of an agenda, there's quite a few slides, so I'm not going to waffle on too much on each of them. There's quite a lot of information I'm looking to go through today, so I'm not looking to cause a headache and create a sort of information overload, but obviously I want to give a wide spread of what's happened and the planning that's been affected, and some ideas to dig into a bit deeper than I may do usually. I may sort of, on some webinars where I have a bit less time, or I might be focusing on something like the NHS pension as well. You know, I don't have as much time to dig in, say, well, this is what it would mean, and this is the type of thing you would maybe look to do in this scenario. So I'm going to go through a little bit into two topics specifically in more detail. We're going to start with budget updates. We'll go into what that impacts on financial planning and sort of what you should look to review generally, that's regardless of the budget, in terms of your financial planning with an advisor. And I'm going to focus on pension planning, and I'm also going to focus on inheritance tax, which are the pertinent sort of budget changes, and we can dig into those a bit deeper. I'll talk at the end about other methods to grow your wealth, and of course that's what we do here, as well as the general financial planning to help you reach your objectives. It really is, of course, everyone's objective to make sure their money works for them as best as possible, and we'll talk about some products and methods of doing that. And I want to talk about the investment markets briefly at the end in terms of where we are, because we've had a very strong year and a half of growth behind us in a really good position. So firstly, we'll get into the budget updates. I've listed that this isn't a holistic list of every single budget update, but these are the important ones for your financial planning. If you want to have more information, you can contact us after of things that relate to you specifically. Of course, there is information online in terms of the full update, but these are the key areas that have changed, which affect most of our clients and most new clients coming to us. For anybody who is a business owner here tonight, this first topic of capital gains tax is of most interest. They've increased capital gains tax across the board. So capital gains tax on things like shares have increased. The lower rate went up from 10% to 18% on the day of the budget, and the higher rate for high rate taxpayers went up from 20% to 24%. On the day of the budget. Now, they haven't increased at the moment capital gains tax on property. So property was at these rates before. It was at a higher rate than other assets. Of course, not your main residence, but buy-to-lets, for example. They may increase in future. I think they're concerned, the government, about causing a housing market crash. They want to obviously try and look after the general public, and that wouldn't suit the housing market or the general public if they caused a mass sell-off or conversely, people not to be selling properties and that to affect prices. So residential property, investment properties, not been affected so far, but could be in a future budget. We just don't know. For business owners here today, ones who aren't imminently about to sell, as in within the next couple of months, the capital gains tax on your sale will go up. It's going to go up to 14% business disposal relief. This is on the first £1 million of gain, so it covers most people. Up to 14% from April, and then up to 18% from 2026, April next year. So it's going up from 10% now to 18% in just over a year's time. So it's quite a sizable increase, really against what was announced by Rachel Reeves prior as in terms of looking after entrepreneurship, looking after small businesses. It is a bit of a kick in the teeth for my business, for your business, but I suppose they justify that these rates are still much lower than other capital gains tax rates and also other rates of tax. It is what it is. Unfortunately, with any budget where they're trying to raise money, especially a Labour budget, they're likely to target businesses, including small businesses, and that's what we've seen. So that's where we are. In terms of, I did some figures in terms of how this may affect you, and actually, if you concentrate on growing the value of your business, and I know that's easier said than done, of course, getting extra value, but if you do grow your value of your business by, for example, 10% between now and date of sale, more than you would have just ordinarily done, this is through methods you can seek Frank Taylor's advice on, then actually that wipes out that additional tax bill. So it's something which you can use to your advantage to take action to actually get the most out of your sort of business value if you are planning to sell it as well. A lot of my clients were waiting for the budget on tenterhooks for pension allowance changes, things like tax-free lump sums, allowance contributions. There was all sorts of rumours in the papers. These were purely rumours in the papers, and I did try to reassure my clients before the budget that, you know, it didn't make much sense for pension allowances and tax-free lump sum allowances to change. The previous government had made quite big overhauls. And at the end of the day, they want to look after with rules after mainly public sector workers, because that has been the theme of a lot of pension rule changes in the last 5, 6, 7 years. It is to create environments where public sector workers are largely unaffected because they want to look after dentists, doctors, teachers, and make sure that people aren't retiring early. So I didn't expect anything to change on this, although I couldn't guarantee it, of course. And we had some clients doing things before the budget just in case. But nothing has been changed in terms of pension allowances. There is a notable change on pensions, which we'll get to, which has been publicly, very widely publicised on inheritance tax. But in terms of how much you can add in and take out, it's not changed. So £60,000 annual pension allowance still remains. Carry forward allowances still remain, as in you can make use of unused allowances from the previous 3 tax years. There is still crucially no national insurance applicable on employer contributions. I did expect this could be reviewed. We've got limited company owners adding big contributions to their pension, which get full corporation tax relief and other tax reliefs, and no national insurance, so that's great. And of course, company owners can use something like salary exchange for their staff to save themselves national insurance, to save their staff national insurance. Really useful to look into that if you've got a business with more than a couple members of staff. So that's not been affected either. The lifetime allowance was removed, as everyone well knows, by the previous government. I did not expect it to be back. That would have been a lazy and boring move from the government, although it would have maybe solved a few of the issues that now have crept up. But they haven't brought it back. There is no lifetime allowance on pension savings. You can have as much as you want. There are other allowances that prevail, however, like the lump sum allowance. You can only have up to a certain amount of tax-free lump sum out of your pension as a monetary value, 268,000 in your lifetime, unless you have some protections in place. So that's all been left the same. So in terms of what has changed on pensions, we'll come to a bit later. Income tax, national insurance, corporation tax, VAT, no change. Widely expected to be the case. Now, of course, portrayed in the budget like very much a positive. We are not changing any of these rates for many years to come, or 5 years, I think they've, or 4 years they've committed to. All that means is that, you know, people are paying more tax, businesses and individuals, gradually, as inflation means these thresholds aren't as good each year that goes forward. So it is a gradual, or what's called in our industry a stealth tax, where it's portrayed to be we're keeping it the same, but because it's not going up with inflation, it is actually getting gradually worse every year. This was fully expected, but it means that kind of business as usual on those allowances. Anybody with more staff will be reviewing the next one with their accountant. Employer national insurance increases, quite a sizable increase. I mean, from 13.8 to 15, but that's proportionally quite a big increase. So for smaller businesses, there's some protection. The threshold before you start paying national insurance for your employees has gone up. So it kind of protects the small businesses. I've got 9 members of staff here, and we're going to see an increase. I spoke to a client recently who has 2 practices and a limited company and sort of 30 staff members, some of them quite highly paid as associates, and actually their national insurance bill is estimated to go up by £70,000 a year. So you can see that the bigger businesses are seeing big increases. Now, this may not cause massive taxation to many of you day to day or in your business. If you have lots of staff, of course, there will be an increase, but it won't be eye-watering perhaps if you're a small business. What it will mean, and we've already seen this in the papers, is big businesses are seeing a big increase in their costs, staff costs, and they may be laying people off. They may be increasing prices. So it's causing a slight inflation concern. We haven't seen that materialize into a big increase in inflation, but the reduction in inflation has certainly stagnated. So it's more of a sort of secondary impact on everybody day to day generally, but it is a key announcement in the budget, that one. Inheritance tax, there have been some changes. Everyone would have heard about the farmers and their outrage at the inheritance tax changes. What it has meant for business owners or agricultural business owners is a change in the inheritance tax relief. There is still a relief, however. It just means it's not as good as it was before. There is no change to the sort of personal nil rate bands. You can have, as a married couple, up to £1 million as an estate left to your family, inheritance tax free. The crucial differences and changes here are business property relief. So businesses that you die with shares in, or farmers with farms, the first £1 million is inheritance tax free, and then after that there is a 50% reduction to the normal rate. So rather than 40% inheritance tax, it would be 20. Now, this is still a relief. Most business owners I speak to aren't massively concerned about this. Most business owners don't intend to die whilst being a business owner. Of course, there's instances where you may not plan for that, but it is not a major concern to day. Of course, the farmers tend to keep everything passing across to the family, and although they get some relief here, it is quite a big change from before when they could leave unlimited amounts inheritance tax free. So that's something of note, and again might have a secondary effect in the shops. Pensions, notably here, have at the moment personal pensions inheritance tax relief. I'll talk about the rules of how it works now and how it may look going forward later. But the announcement in the budget, the key announcement for clients with personal pensions or defined contribution pensions, is that pensions will not be inheritance tax free from April 2027. We do not have any rules or confirmations about how this will work. That does not mean that there is going to be inheritance tax itself applied to pensions, because that's quite tricky to do, because a pension is actually technically a trust. It might be something a bit different. But what it really means is the government announcing you're not going to be able to save into a pension, then just leave it onto the family inheritance tax free, as you can kind of do now. There will be some consideration of tax on death, which will incentivize people to take money from pensions, kind of what they're intended for. As soon as the old government, the Tories, removed the lifetime allowance, this was always on the cards, and I can guarantee that this would have been proposed by the old government, something of this nature. We don't know the rules from Labour yet, and they may be more oppressive than perhaps what the Tories would have announced. I think that in the March budget last year, all that was announced by the old government was, we're removing the lifetime allowance as they'd announced a year earlier, but here's how it's going to work with the new lump sum allowances. I guess they were probably planning to announce either then or maybe a year or two later something like this, because it made absolutely no sense for any government to remove the lifetime allowance on pensions, allow people to feasibly save millions of pounds into pensions in their working career, and then have no incentive to take any money out if they're very wealthy, just leave millions of pounds onto the family inheritance tax free. So as soon as the lifetime allowance was removed, this was always coming. So it's partly the old government, partly the new, but there is no blame from me here on the Labour government, I would say, in terms of bringing something like this in, because this would have been planned by the old government in some form. We do not have the details on how this will work yet. It will mean that people are incentivised with personal pensions to take income out of their personal pensions in some form. That does not mean that you panic and take money out your pension now. You should work with an advisor to sort of come up with a plan that accounts for your tax position now, what maybe money you'll need in future, what your inheritance tax liability may be in future, and perhaps accounting for what the rules may look like as a guess at the moment while we work it out. And some clients I'm taking action on now, some I'm saying we need to wait because, for example, you're a 40% taxpayer and we don't want to suffer tax where we may not want to. Couple of other notable changes on the budget: private school fees. Many of our clients have clients in private school. This wasn't news. They announced last year this would be happening. VAT applicable, no way around it. Stamp duty, land tax. So stamp duty is going up on new investment properties, company purchases, that sort of thing. A non-DOMS tax. The government are trying to get rid of this non-DOMS status. They're reversing a little bit on their original proposals. It's all being worked out, but they're going to make it less easy to be a non-DOM status and avoid paying tax in the UK when you're effectively living here, but you're not on paper. So that's really it in terms of the budget updates that I wanted to talk about today. I want to just note now as a little interlude before we get back into the sort of more technical side on the tax planning, on the pensions and the inheritance tax, more general financial planning. These areas are pertinent and important regardless of what stage you are, whether you're just starting in your career, whether you're a business owner midway through like me, whether you're planning your retirement, whether you've already retired. All of these areas are really important. So pensions always first. Are you using your allowances? Are you looking at your pension planning? You know, even if you're younger, you can still get great tax relief adding to a pension, and sort of little and often will mean that you don't have to rush and try to commit large sums when you're later in life. Of course, if you're approaching retirement and you haven't looked at this is absolutely crucial, because when you've retired or sold a business, your allowances will likely be either pretty much nil or at least much lower to add to a pension than you can now. And then you can't make use of all these great tax reliefs on adding to a pension. Have you reviewed your NHS pension? I'm not going to go into great detail on the NHS pension today, but if you haven't reviewed it, review it. You need to review it at the moment because of all the McLeod judgment changes and all these new letters you're getting and going, oh God, this has changed, that's changed, what should I do? So come to me for advice and I can help with the NHS pension. You need to, if you've got a pension, not just save and not think about it. Make sure it's working for you in terms of its growth, its strategy, its features. Can you access flexible drawdown or other flexible retirement income features in retirement? Are you a few years away and think, well, I've got a few old pensions, I'll just work it out then? Have a look at it now, because otherwise you might have to go through an onerous process when you actually need the money. And of course, are you prepared? Do you have enough income for retirement and planning for that? Savings aside from pension planning, because pensions aren't the be all and end all. You might have already used your allowances either with the NHS pension or elsewhere. You should look at savings, ISAs, other investments, other ways to grow your wealth, not just leaving money in the bank, whether that's in a business or outside. Oh, I've got some money there. Well, is it working for you? Is it getting high rates of interest on a cash account? Are you using your ISA allowances so you've got tax-free growth? That side of things. Has your partner saved is a crucial area that we look at for clients. You generally get clients a bit lopsided. That's just the way it goes. It is the way in my marriage as well, that, you know, one earns a little bit more than the other, might have a bit more saved in pensions than the other, but gradually as you go, it's important to review and look to use where suitable both partners' allowances, because you might have advantages in saving in your partner's name over yours in certain instances because of tax reliefs or tax positions in retirement. Tax planning wise, always, every client, of course, wants to look at, well, I want to grow my wealth, but is there anything that can save me tax? Not through a dodgy loophole, but through government sanctioned tax reliefs like pensions, like other planning that your accountant does with ourselves, like other investments that give tax relief or other methods that give tax relief. That's really important. And then I've mentioned about business sales here, because a lot of clients here today may be, with the budget updates or with just the way the world is at the moment, looking at, well, I'm planning for a business sale. So preparing for your business sale, maximising the value, limiting the capital gains tax with certain methods and planning, And of course, inheritance tax we're going to touch on in detail today as well, because that's very much a hot topic. So I'm going to talk about pension planning now specifically and in a bit more detail. There is quite a lot of information here, so I'm going to obviously be able to send you the slides and the copy of the webinar afterwards. And really, coming to myself for a consultation and some advice will give you the overview specific to your situation. In terms of NHS pension, all these pension rule changes have only been of benefit to NHS pension members or defined benefit scheme members. We often had clients with big NHS pensions over the lifetime allowance, and they might have been thinking, is it worth being in the NHS pension anymore? I'm over my allowances. Should I take the pension early? That was causing this conundrum. Actually, if clients came to myself at the time, it's likely in many cases it was still worth being in, because you only paid a small proportion of the money to the pension and the NHS added the rest. And also taking early likely wasn't suitable in many cases as well. But we had a lot of clients who came to us after they'd done it and said, oh, I did that, I didn't know what to do. This removal of the lifetime allowance has got rid of a lot of that conundrum. And that's why the previous government have done it with the counter to do what they've done for personal pensions. You do not leave with your NHS pension a big pension lump sum on death. So there is no inheritance tax issue. The pension will be paid to you when you retire, and then when you die, it's paid to your spouse if they outlive you, and then if you die when they die, your children get nothing in nearly every single case, unless they're in long-term care or they're minors. So it really is valuable for when you're living and when your spouse is living only, and these new rules don't change anything. So you can park that for the moment, and we'll concentrate more now on personal pensions and defined contribution schemes. So if there's a company pension which you or maybe your partner has, which just saves into a pension through their employer, but actually is invested in funds as opposed to being this sort of set income at retirement, that's a defined contribution scheme. So as noted, from 2027, the only thing we know is that inheritance tax regime, the inheritance tax regime and relief will not apply. So pensions will be subject to some form of tax. No rules have been announced. It may not be inheritance tax, as I said. I think it's more likely that it will be a tax on the pension itself, sort of a pension death tax, they may call it, at a certain percent, might be 30% of whatever's left. And that will allow them a bit of flexibility to maintain some of the reliefs that are there now, in terms of if you die early before age 75, which they may consider as being certainly valuable to maintain, and not force people to take money out when they may not may not need it, spend it, and then not be left short later in life. We just don't know. Another reason it might not be inheritance tax is because inheritance tax is a personal taxation, and many years ago when I first started, there was a similar tax in place. There was a tax on death for drawdown pots. If you were invested your pension, left it invested and took income, there was a tax on that drawdown pot if you died. They said we can be flexible, but if you die, we're going to take a chunk of it. So sort of moving back towards that method now. Clients at that stage could choose to, for example, say, well, I want to put a pension into a trust. So it's not mine anymore. And you still have the option to do that now, but wait before considering anything like this, because if they bring in a tax on the pension pot, it won't matter if it's in a trust or not. The government aren't stupid. They will have accounted for all these eventualities, all these loopholes, and they'll bring in some sort of rule that covers everything and won't allow people who are very wealthy with £1 million in a personal pension to say, well, I'll just put it in trust and then there's no tax. Okay, so that's something which will likely not be the case. The current rules are, if you die with a personal pension pot or a defined contribution pot, doesn't matter if you've started taking from the pension or die early. The rules are, if you die before age 75, the entire pot is left completely tax-free. No inheritance tax, no income tax. So if you have 500,000 in a pension pot and you die, 500,000 goes to your spouse or your family, depending on who your beneficiaries listed are. Most people, of course, and we hope for yourselves, death after age 75. And what happens now is you leave a pension pot to your spouse or family. They then have the choice to take money from it if they wish. They don't need to, they can leave it invested. But when they take any money, or whoever they leave it to then takes money in future, there will be income tax at their marginal rate applicable. So you can see here, in many cases, there is some tax. There is going to be tax on pension pots. The problem with this method is it might be 40 years away. No government, especially one with a big deficit to cover, and obviously wanting to fund schools and NHS and other public sector as they should, wants to wait 40 years for pension income tax for more wealthy clients, and some of our clients who are saying, well, I've got other money I'll use to fund my retirement, I'll leave this pension on. So this won't be the case exactly like this in a few years' time, and hopefully later this year, in the summer or later this year, we'll get the details on what they're going to announce so that we can pre-plan a little bit. What I think is quite likely, if they bring in this percentage tax on death, like whatever the situation you're in, we'll take this chunk of it, for example, then they could, for example, maintain, aside from that tax, these rules. So everything else that's left is adhered to. The rest is paid out tax-free if you're before age 75, or after age 75 goes to the family with a bit of flexibility. Okay, so that's the way it is now, but that'll only be for another couple of years, and then we'll find out and announce, of course, to our clients and advise them what the new rules are. Now, a lot of my clients are really let down by this, you know, the ones who have accounted for their big pension that they've saved up and grown with us to help them with their inheritance tax planning. You know, it's a bit of a nightmare. You've got all this wealth, that's great, but then people are thinking ahead, say, I don't want the government to take a big chunk of it. So we'll get to that in a moment, and it is something which you can plan for. But the pension used to be such a great tool because you get loads of relief adding into a pension, loads of tax relief now, you get tax-free lump sum you can take, and then, by the way, if you don't take the money, you got loads of tax relief on death. So it's really, really good. That's why the lifetime allowance was in place, to say they're really, really good. Doesn't matter what the situation now and in future, but you can only have £1 million in them. And as soon as that was removed, you can see you can't feasibly have this without a cap, because people would be able to save millions of pounds and grow millions of pounds to pass on. So the main question from clients is, oh my God, does this mean that we are now in detriment from having done the pension? Never, okay? That is almost certainly not the case. There's only a couple of very rare instances where you would ever be in detriment. If you only got 20% tax relief when you saved, but you're going to be a 40% tax relief taxpayer in retirement. That's really rare, because obviously people tend to be high earners and high earners in working life and high earners in retirement. So everybody else, you're going to get a benefit from putting the money into the pension and taking it out. All these new rules are in place for the pension death tax, to really not just say we'll take a chunk on death, but it's really to say you get all this benefit saving into a pension, no problem. But we want you to take some income in retirement. That's what a pension's for. So I've done a table here that I send to my clients, and it gives an insight into an example of £10,000 paid by you into a pension, and based on different tax rates, what that means for the uplift based on just putting the money in and taking it out. We've done it for high rate taxpayer now and basic in retirement, basic now and basic in retirement, and higher rate now and higher rate in retirement. So they're the most common. The first one is if you're a 40% taxpayer now and a basic rate taxpayer in retirement, pensions are so beneficial in maximising your wealth, because you can see here, if you pay 10,000, the government add 2.5 on top, you get another 2.5 back through your tax return, tax relief. So you've only paid 7,500, you got 12.5 in your pension, and then in retirement you get 25% tax free, the rest in this instance taxed at 20%, and that gives an uplift on your capital of £3,125 in this instance. That equals 41.67%. That's no growth. That's no growth on top. That is so beneficial. So this is really crucial to demonstrate that for these instances, saving to a pension is still the most effective planning that you can do for your retirement. And it's the best way to maximize your wealth. You do need to be wary of overall allowances. You do need to be wary of sort of tax reliefs and doing it in the right way. But for 99% of people, pension, where affordable, because it's for the future, and it's really still the best method regardless of this new announcement from the government. It just means that you'll be planning to take some income out when you retire. Basic rate, you can see in the same instance, there's a 6.25% uplift, nowhere near as high because there's not the tax relief change. But listen, 6.25% from the start is a very big benefit. And as you can see from all these tables, the growth on top amplifies this 6.25 or 41.67% uplift from the start, because all that extra tax relief you're getting added at the start gives you extra growth on the money that's in there. So as the money grows, these increases amplify and get better and better and better. So I always focus on just the money in, money out, no growth, because it's really easy to understand. But you can see here the amplification of the growth on top. And then of course, clients who think, well, I'm going to be a 40% taxpayer in retirement, so what's the point? Well, the point is, if you get 40% tax relief now and pay 40% tax when you take the money out, you actually get a 16.67% uplift on the money. That's even better than the basic to basic. So you can see here that there's big benefit in saving into a pension, even if it means that you've got to take the money out, okay? A lot of you here tonight might be limited company. I am, lots of our clients are. Works a little bit different. That previous one was based on personal pension contributions. Of course, people like sole traders or employees or associates might do that. If you've got a limited company, the rates and the changes recently have actually meant that there's even more benefit adding in from a limited company. When you add in from a limited company, you take a chunk of your profits, you say, I'm going to put it in a pension. It gets full corporation tax relief. It's now in personal ownership in the pension. It can be invested to grow, all those other things on top. But you save corporation tax relief now, and then of course you save capital gains tax when you eventually wind up the business. So I've done a little example here. Now there's a few more variables that can apply. So this is just an example, and as it notes at the bottom, you need to work with your advisor and accountant to do an exact one. But it's not a excessive one to say, oh, this is best case scenario. There's loads of ones where it would be even better. This is really a kind of mid-range. And if we look at two examples on £20,000 profits in a limited company, option one being retaining the profit in the limited company. You don't want to take them out because you're taking enough up to your maxes for dividends, and you don't want to pay too much tax or lose your personal allowance. You don't know what to do with the money. It's in the company. If you retain it, you pay 22% corporation tax in this example. So you've got £15,600 left in the company. In future, you sell the business, pay best case scenario based on the new rules, 18% tax from April 2026. That's that 2,808. And that gives you in your pocket from that £20,000 profit you originally got, £12,792. If you add it to a pension, you don't pay corporation tax. £20,000 goes into a pension and gets invested. No capital gains tax, of course, because it's out of the company and it's been deducted from the profits and the capital value. And then in an instance where you can take it 20% taxable, you get 25% tax-free on all pensions and 20% tax on the rest. This equals 17. So this is a 33% uplift on the money. Even if you accounted for 40% tax, there's still a decent uplift on the money. So it's really important to look, if you're a limited company, on the options for this. And because you get more sort of control about profits, the benefit of a limited company isn't setting up a limited company and taking every penny of profit out, because otherwise, in some cases, you might as well just stayed as a sole trader or a partnership. It's that you can control it. You can say, myself, my partner, we're going to take 50,000 each or just over from the company and pay basic rate tax. So you might go up to 100,000 each before you start losing your personal allowance. We've still got profits there. We've spent it on the business. We might have done the bits and bobs we want. We've got 200,000 sat in the company. It's getting absolutely no return. In fact, it's getting a really measly rate of interest in the bank, because the banks offer terrible rates for business accounts. They don't offer you like the same rates as you would do if you went to them as an individual and asked for a savings account. So what do we do with the money? Well, this is an option. So you have to work based on your allowances and based on your sort of situation, but this is a crucial option for those in that position. I want to focus now on inheritance tax planning. So the thresholds haven't changed, But obviously this pension inheritance tax change has created another sort of conversation with clients. Well, if I'm taking money out my pension, okay, paying some tax, okay, but then what do I do with that extra money? Or what do I do generally to plan for inheritance tax if that pension option of leaving that isn't on the cards? So I've noted that you need to plan and calculate it properly. It's not just about working out, well, my estate's worth this amount now and I've got £1 million tax free, so this is my liability. Well, you've got to forecast forward, because in some instances you'll forecast to age 85 or various ages later in life. Well, here's where it would be this value or this value in today's money. Therefore, I might have a bigger inheritance tax liability for some clients when I get there, because I've got lots of wealth, big NHS pensioning income, for example, and probably I'm going to grow my wealth as opposed to spend it. There might be some clients, of course, where it will drip down. Most clients who spend their income and their capital when they get there. So it's important to forecast ahead, and we can help with that with cash flow modelling and retirement income modelling. The rules are you've got up to £1 million as a married couple, but if your estate's worth more than 2 million, that starts to drop down, and you can lose what's called the main residence nil rate band, which is an extra 350,000 you have on top of your normal 650 as a married couple nil rate band. So everyone will have 650,000 as a married couple, 325,000 each. But if your estate's worth more than 2 million, the additional bit might taper down, and that's something people might not account for. At the moment, personal pensions, you could have 5 million in personal pensions. They do not impact on the tapering over 2 million. They don't impact on inheritance tax. So what the government have said is inheritance tax, but what they really mean is they're going to be brought into this in some form. They're not going to be excluded from these calculations. And that's why I think they use the word inheritance tax in the budget, not that they will actually charge inheritance tax itself, because that's quite tricky to do. The obvious method of planning is, skipping ahead, is gifting. I mean, really, the one I haven't mentioned here, spending, spending, whether that be on yourselves or your family. You don't want to leave yourself short, but, I have clients who have wealth growing, and actually spending and enjoying the money is the most effective way, because that's for you to enjoy it, the hard-earned wealth that you've got, but also to, mean that it's not sort of just building up in your estate. Of course, you don't want to overspend and leave yourself short, but I do have some clients who have, what can we do for inheritance tax plan? I say, well, you can spend a bit more. I'm not an advisor who just hoard and invest and everything. Spending and enjoying your retirement should be the first and foremost part of this. After that, you might look at gifting. There's some allowances here that I've listed. Information is available at the government website. If you just type in gifting allowances, gov.uk website has all the sort of list of the allowances and exemptions. £3,000 a year. There's extra allowances for things like £250 cash gifts to multiple people. If you have a child's wedding, you can add give £5,000. It's all outside of your estate immediately for inheritance tax. Two that I'd like to focus more on today, the more substantial ones, are regular gifting out of expendable income. For example, you could be in a position in retirement where you've got a personal pension you're taking income from. You might not need the income. Now you can reinvest that. You can reinvest it into ISAs or other investments and keep it working for you. But remember, they're still subject to inheritance tax. So anything in your estate is going to be subject to inheritance tax pretty much, or some sort of tax on death. You can gift out of regular expendable income. If you quantify our income is £80,000 a year as a couple, and we spend £50,000 a year, then you've got a £30,000 gap that you can feasibly do regular structured gifts to family, to children, grandchildren, whoever it is. And technically that should be outside of your estate immediately for inheritance tax. So that's something to look into. Any gifts made outside these, you don't have to adhere to these structures. You can gift, as a cash gift, whatever you want. We get clients who sell a business, £500,000 or £1 million sort of cash left over. Well, I'll gift my two children £100,000 each. There's no tax between you when you make the gift. It is simply that you have to live for 7 years for that gift to be outside of your estate for inheritance tax, okay? Trust planning I want to touch on. It is quite complex and specific to your situation, but I often get new clients coming to me saying, I want to set up a trust. There are two main types of trusts. Absolute trust, which is where you name a beneficiary. You might say, my two children are the beneficiaries of this trust. You gift money and invest within a trust, and then that's for their benefit. So these are really simple and easy to understand and to plan. You're effectively moving that money out of your ownership when you set up the trust and pay into it. 7-year rule applies, but you have some control about managing the money within the trust for their benefit when they're older. Or when you decide when to pay out money. So it's kind of not having to gift a massive chunk to family members. If you think, well, they're only 23, I'm not sure I want to give 200 grand to them. Yeah, this is an example. These are really, really commonly used by our clients for grandchildren, because grandchildren, the tax will fall on the grandchild, who actually, even if they're 2 years old, will have a personal allowance, a capital gains tax allowance. So technically, you can then grow the money really tax efficiently for them, because there's basically likely no tax while they're growing up, or even when they're in their early 20s or teens, certainly when they're maybe studying, and then pay out the money at your discretion, whether it be for university, for a house in future. These are really commonly used for grandchildren specifically, but also for adult children in certain instances. And discretionary trust is the most common question I get. I want to look at a discretionary trust because everyone thinks of trusts and thinks discretionary trust. You don't need to list your beneficiaries. These are how trusts used to work sort of 20, 30 years ago. You'd set up as a wealthy family, a family trust, put your properties in there, put your investments in there. You don't have to name who's the owner, so you don't have to worry about your children getting divorced. It's all in this trust passing through generations. Brilliant. Still works like that now in that respect. You can pass wealth on through generations. You don't need to list the beneficiaries. You can just pay money in, blah, 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 7-year rule. However, there are very high tax charges within the trust, the highest possible for income tax, capital gains tax, very little allowances for tax-free amounts. There are 10-year tax charges on the gains within the trust. There are exit charges. There are very onerous accounting, annual accounting requirements within discretionary trusts. This isn't new. This has all been for the last 10, 15 years. They've been obviously targeted as an inheritance tax avoidance method, and said you can have all these flexible benefits, but there's all these taxes to consider. So for really wealthy people with massive taxes anyway, that might not be a concern. You might think, well, I would have paid high taxes on my wealth anyway, I might as well use this trust. But for 9 out of 10 clients who come to me to ask about these trusts, they don't bother doing them because these extra taxations are very onerous, and in lots of instances they will mean that it's not worth doing this type of trust. It might be worth doing an absolute trust or something else. So don't be put off completely. They are very powerful for estate planning, but they come with their costs, which should be duly considered. There are other trusts available. There's lots of hybrid trusts where you like gift and loan trusts, where you're technically loaning money to the trust. All the growth is outside of your estate, but the original value can come back to you, but it's not inheritance tax free. We do a few of these. Obviously, they're not pure inheritance tax vehicles. But generally the main 2 trusts above are the ones used, and obviously we can advise you on the best one for you. Investment properties I often get asked about. There's nothing tax efficient about investing in properties. That does not mean that I don't like investment properties. That doesn't mean you shouldn't consider having some. I would be really wary about trying to just build up a property portfolio and not invest your money as well and get some tax efficient methods alongside, because when you buy properties, when you've got income, when you've got to sell properties in future, and for inheritance tax, there's big tax problems over doing other investment or financial planning. So we get asked with people with lots of investment properties, and they're coming up into their 60s, 70s. What do I do? Well, none of the options are particularly good, but let's break down some of them, because there is something that should be done likely in most instances, and it will require some consideration for individual property merits and sort of financial details. So if you keep all your properties, you don't pay capital gains tax on death, but inheritance tax will apply. Okay, so 40%. So that's not good, but that's an option. Just saying, we'll carry on with the income, carry on with the growth, but the family will take a hit, and they'll probably have to sell off the properties, maybe on the cheap, to pay the inheritance tax bill. Not an ideal situation, as you can see, but that's an option which some people might consider. Selling properties, this doesn't mean all of them, but selling some of them. Capital gains tax applies. what I would always say is a property is just an investment, like any of the investments I set up. It's not to be just clinged on to until death. There should be consideration in future of saying, I'm going to sell that, cash in, pay a bit of tax on the gain, and use the money more flexibly for other methods that we have either talked about or will talk about. So there will be capital gains tax on a property. It might be not a lot, it might be a lot. There's something you might be able to do with assigning ownership partly to your spouse, where there's no capital gains tax transferring ownership of assets between spouses and paying a bit less tax. That's something we can help with. But there will be tax on a sale. If you gift a property or if you gift into a trust, it's the same thing. There is capital gains tax, same as selling it. You're deemed to have gifted, you're deemed to have sold it at the value that it was worth when it went into the trust, even though no money changed hands, so capital gains tax applies. And of course, we have clients who hold properties in limited companies. That solves nothing for inheritance tax planning, because inheritance tax will apply on property limited companies. What it does do is creates a little bit more flexibility in gifting the shares of the limited company away, because you can easier unitize the shares as opposed to a property, to do it in a more tax efficient way to families. So if you're going to keep properties for the long term, you think, I'm going to keep them, then I suppose a limited company could work in that respect, but you're going to have inheritance tax issues still. So a big danger, if somebody comes to me, and I've had quite a few 70s, even 80s, saying, I've got all this, what do I do? If you sell or gift your property to a trust, and then you don't live for 7 years after you've done it and sort of moved the money out of your estate, the proceeds or the using a trust, then you've paid capital gains tax and you pay inheritance tax. It's a double taxation. This is the risk. This is why you don't wait till your mid-70s to look at this. This is why in your 60s, when you've sold your business, you've retired, you've worked out with an advisor how much you're going to need to live on. Do we need all this money? You don't just say, I'll sit on all these properties for the time being, because this will come up in future at a time when you're more concerned about the 7-year rule. So forward planning is absolutely clear, absolutely key here. And generally for clients who have, 4, 5, 6, 7 properties, a mixture of strategies is suitable. You might look at one which has not got a brilliantly high yield or might have a troubled tenant. You might sell that one. You might have one you've bought 45 years ago and the capital gains tax bill would be enormous. So you might think, I'm just going to keep that one because, I don't want to pay £100,000 in tax. So we can work with you to look at the data to sort of help guide. But, at the end of the day, it will be up to you what you do with them. There are a few other things you can do with inheritance tax in terms of investments. You can invest, and we can advise on these, into products which give a 50% reduction to inheritance tax. So you pay 20% inheritance tax rather than 40. So you might have a chunk of money, you think, I want to move into this later in life. And actually that gives, on £1 million, that would give a £200,000 saving potentially to the family on inheritance tax by having this type of investment. You might invest into other businesses, yourself. Obviously, that would be give you potentially even more inheritance tax relief, but it comes with its efforts and obviously risks with investing into a new business, especially if you're trying to sort of settle down and look after your money for retirement. If you have ISA savings, you can move into what's called AIM shares, alternative investment market, UK small to medium-sized companies. And you get the same relief that I spoke about before. You pay 20% inheritance tax rather than 40%. And there's an investment called Enterprise Investment Scheme, which gives business relief, like we spoke about, half the relief, but also you get 30% income tax relief going in. So loads of tax reliefs. But these investments are generally higher risk strategies. So we might build in, if you have £1 million invested, we might say, well, for a little bit of your money, you might do little bits here and there of these and spread things out and sort of build in some of this planning for clients if they're that way inclined. It shouldn't be, I'll just do this with all my money, because generally these methods are a bit higher risk that you want to do gradually later in life, and also with advice to consider that. Other investment options, we spoke about pensions, we spoke about inheritance tax planning, but in terms of where you should be saving your money, you should be always looking at ISAs, investment ISAs ideally, but if you need maybe access to the money, look at cash ISAs. tax-free growth. Really important, because you want to make sure whether it's interest, whether it's investment growth, you get that tax-free and you don't have a bill later on. Where possible, £20,000 annual allowance, and then you can build up a portfolio that really can be used to grow your wealth very well later in life. Venture capital trusts are an investment which give 30% tax relief on investments. So clients who might be in their 30s, 40s, who don't want to commit all their money to pensions because they might need some of it sooner than they can access age 55, 57. They might do some of these and get some other tax reliefs as well. And you have to hold for 5 years. You can invest into investment bonds or general investment accounts, which give some tax advantages and flexibilities in terms of investments and accessing the money. And then if you're not looking to invest, but you want to use your cash actively rather than just sitting in a current account, look at cash portfolios, look at fixed interest deposits or high interest accounts, because you'll get better interest rates likely. But any cash, regardless of whether it's offering a higher interest rate or not, is very likely to lose against inflation long term. We're in a weird position at the minute where interest rates are still high, inflation's come down, but rest assured, base rates will come down soon at some point, whether it's in a month or 6 months or a year, and then we'll be back to where we were for many, many years before, which is that cash interest is lower than inflation. So it's effectively getting eaten into every year. You don't want to invest every penny you've got. You need to keep your cash pot, your emergency fund, money that you've outlined for expenditure in the next couple of years. But if there's money left over, using it actively is advisable. Finally, as I'm running over slightly, although we haven't done the full hour, I want to give a few minutes for questions. Current investment market. So anyone who invests at all will have seen big boosts in the investment markets in the last year and a half. After a bit of a stagnation in the financial crisis of 2022, this 5-year performance chart demonstrates some example portfolios. By no means the best performing, just kind of half decent performing portfolios in the markets for higher risk, medium, and sort of medium to low in the last 5 years. And actually you can look. Can you believe it? It's basically nearly to the day 5 years since COVID started. You can see that initial drop here was just after COVID started. Everyone went, what is this? So this shows a very sort of up and down chart of what has been a bit of a roller coaster the last few years. But preceding that, we had 10 years of very stable markets. It wasn't always growth, but really it was a lot less ebb and flow. We've seen, even with the COVID crisis, even with the major financial crisis in 2022, we have seen very good growth for clients' investments, especially for the ones taking a bit more risk. So if you have any existing investments, we can happily review them for you. It doesn't mean we're looking to take over, but we can make sure they're performing as they should do. They're aligned to the risk level that you want, that they're well spread, that they are diversified, that they're well managed, and that you get the most out of your money. And, you know, it goes without saying, I don't need to go into detail today, that having an expert like myself or another advisor looking at your investments and making sure that you take advantage of market movements like you can see here will give you the most in your pocket long term. That just about wraps up the slide. So you can contact us for a free and no obligation consultation. My contact details are there, and please do get in touch afterwards if you would like to speak to me on a Zoom, on a call, and then we can go from there. I'm just going to delink my screen share, and I'll look to see if there's any questions. No questions have been left. If anyone thinks of any questions after this, of course, come to me directly and we can have a chat. I'll let you all get off to enjoy your evenings. Thank you so much for attending this evening, and I'll hope to speak to you all very soon. Thank you. Bye-bye.